Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. In February's show, we are assessing how traders can get the best deals for investors at the point at which bonds are issued. Getting access to the primary markets can be key to delivering returns in fixed income. We're going to learn how with Stephen Yeats, Head of APAC and EMEA Fixed Income Beta Solutions at Tier 1 Asset Manager, State Street Global Advisors, and Bill Sherman, Executive Vice President of the Global Markets Group at primary market specialist Ipreo. Government bond data is kindly provided by MTS. Stephen, welcome to Trader TV.
Thank you for having me.
So from an investment perspective, what's the difference in value that can be achieved by taking bonds from the primary market, the point of issuance, rather than from the secondary market?
There's value in both, but on a very basic level, the primary market is about buying bonds directly from the issuer. So there's some benefits of that, both in terms of liquidity and minimising transaction costs, but also in terms of earning a premium, because the issuer may be willing to offer a discount in order to sell those bonds directly into the market. So there's benefits from both of those points of view. And, when you're trying to add value in portfolios, primary market is a good place to start.
Okay.
The second thing which is important is that primary market itself actually drives liquidity in the broader bond market.
Okay.
So if I'm buying a new issue that's coming out from an issuer, then it's likely that I'll be selling something else. So around primary market, you also get increased liquidity typically in other bonds because investors are selling other bonds in order to buy the new bonds that are being issued.
I see. Oh, that's a really interesting dynamic.
Yeah, and the other thing about the low yield environment is that essentially the tolerance that you should have for transaction costs is very low, because if you're only earning 1 or 2% or 3% on a bond portfolio, then any transaction costs that eat into that, reduce your yield quite significantly as a percentage of what you're actually getting.
Sure.
So primary market is one of many strategies to help minimise some of that. So again, the idea that by buying directly from the seller, you're not only avoiding secondary market trading costs, but also getting that premium.
Sure. And what's the difference for the trading team in terms of the way they engage in the secondary market versus the primary market?
It's fair to say that there's value add from the trading team in both. It's just quite different value add. With primary market, the key for the trading team is to work with the portfolio managers to understand what bond is being issued, how it compares to the secondary market, and then ultimately what sort of demand for the bond that the portfolio manager has. With the secondary market activity, in some ways there's even more value add from trading, because it's a more challenging task to locate where the bonds that you need are, and to actually get them at a price that's reasonable. So I think the value add from traders in secondary market can be quite powerful, because if you know where the bonds should be pricing, and you know where to get them and who's the best counterparties to ask, that can be real value add from the trading perspective.
Would you be able to measure the value that you get from the primary market versus the secondary market in fixed income? Is it primarily from primary market issuance?
You can't just rely on primary market for all of your liquidity. You need to be in the secondary market. If you're looking at virtually every primary market deal that comes, then you actually understand where the bond market's going from a structural perspective. One of the things about the bond market, again versus equity markets, is because bonds mature and are issued all the time, it's a much higher turnover in the overall market, and that means that the market can change quite a lot. So you can see new markets coming rising. I mean, you see this in the Middle East at the moment, that there's a lot of issuance from countries that have never really historically been issuing. You see new types of instruments being issued. So if you're looking at the primary market and you're understanding both what's being issued and where it's being priced, that's incredibly valuable to your understanding of the secondary market down the line, because those bonds that you're buying now, or you're not buying depending on your view on them, they then become the secondary market. So it's a good discipline, in our opinion, to be very focused on what bonds are being issued, where they're pricing.
How important is the interaction between the trading team and the portfolio management team?
Yeah, I mean, it's absolutely crucial, and the way that we've structured our team is to have PMs co-located with traders, and not only that, but also by sector. So we view that interaction and that specialization as very key. I mean, a good example is in an area like emerging market debt, where we have a strong franchise. We've got portfolio managers and traders who are managing segregated accounts alongside exchange traded funds and mutual funds.
Yeah.
And in engaging in this activity and engaging in both the primary and the secondary market, and having a specialism around the sector that they're engaged with, there's a much deeper understanding of the bonds themselves. When you think about trying to minimise transaction costs, there's one way to view turnover in the bond market, primary market. Some would view it as unwelcome turnover because it's turnover, but actually, if you've got a very effective relationship between trader and PM, in some ways there are some opportunities there, both in the primary and the secondary market.
Sure. And are there any particular strains that occur in the workflow between the trading team and the portfolio manager? Time.
I mean, that's always is I guess often a challenge in life, but in terms of primary market in particular, deals do tend to come quickly.
So when you say that the orders or the issues can happen at quite a fast pace, how quickly could we be talking about? And also, how many deals might we be having in a day?
So the speed can vary quite a lot by market. So there's certain geographies and markets where book building is a lot slower. But typically in Europe, for instance, deals can come and go pretty quickly within a morning. So that does put some time pressure on asset managers and traders in general. And I think the key to that is really organising your setup on the desk to make sure that you're in the same time zone as the market that you're looking to access the primary market, and also that your traders and your PMs understand that they're going to be on the desk in the morning.
Yes.
And then they're going to be very busy.
If all this works well, what should the end investor be seeing from that sort of seamless integration between the traders, portfolio managers, and the relationship with the wider market?
I think ultimately it's about, from an investor's perspective, it's about transaction costs, minimising transaction costs. There's also opportunities as well. So, being engaged in primary market, you can earn a premium for doing that, and that's something that's interesting to investors. Obviously, if you are an investor who has large amounts of capital under management, then thinking about the liquidity of the market, understanding the market liquidity, and having that built into your asset allocation framework is important too, both in terms of kind of the levels of transaction costs you might expect, but also in terms of the timings of your allocations.
Got it. Stephen, thanks very much.
Thank you.
It's been great. The sheer volume of bond issuance can prove challenging to manage for traders and portfolio managers, creating a risk that opportunities might be missed or errors made. New ways of working are being explored, and to investigate those, we're going to talk to Bill Sherman, Executive Vice President of the Global Markets Group at primary market specialist Ipreo. Bill, welcome to Trader TV.
Dan, thank you for having me. It's a pleasure to be here.
So my first question is, how would you characterize the challenges that you see for investors in the primary market at the moment?
Basically, you have a situation where there's a tremendous amount of deal flow in the marketplace, and there's not really a great way to very efficiently or effectively manage the amount of information that's coming to you if you're a buy-side firm. In the primary market, the pace of deals, the amount of information, the amount of data that's coming to them, just to the struggle at which they need to be able to handle everything in an organized fashion is really the biggest pain point that we see.
And so what have you been engaging in the market? What have you been doing to assist firms in resolving these challenges?
We've been involved in an initiative called Investor Access. And part of the concept that we've been involved in, both with the sell side and the buy side, both sides of the market understanding that it's that they're both engaged and both have to work collaboratively towards a solution, has been in trying to figure out a way for the banks to communicate in a constructive, structured format to the buy side, and for the buy side to receive that information in a structured format. We went live with the first deal to actually be open for orders and take orders electronically and give allocations back in January of last year. I believe the date was January 5th. Since that time, we've seen a real big uptake in terms of the solution itself. So we went from 11 banks to now 32 banks on the system. We have over 150, close to 200 investors actually on board in terms of being able to utilize our systems either to view deals or put orders on deals. That number of firms that can put orders on deals from the buy side perspective is just shy of 150 investors. Wow. That's up from less than 10, I think, in January of last year. But we've seen an acceleration, and the best thing that we've seen is just a pickup in the amount of publishing. So 90%, just about 90% of the European market is being published over the platform today. Of those, over 90% of those deals are actually enabled to receive orders on them. The number of orders so far through the middle of February, I believe, is just about as great as the totality that was there in all of 17.
That's great. Thank you very much. Very impressive figures. So could you help me? Could you unpack some of the challenges, the specific challenges that you're helping portfolio managers and traders to solve?
On any given day, historically, the way that information would come to you would be in a series of emails, text messages, or phone calls from multiple banks if you're, the buy-side entity on the other side. So you had this process where if you had 10 deals on the market, and today I checked there are 10 European deals, it might be 11 today, that are on the market, there may be, upwards of 30 banks that are on those deals in totality, right? So several banks on every deal, and basically hundreds and hundreds of investors all communicating with the banks. And so the first thing we came up with was a way of expressing information in a structured way. So rather than having to rifle through, hundreds of text messages or phone calls or emails, and we now provide a way for you to see all the information that is being sent to you on one deal. You're able to actually see that in something we call the deal monitor, which allows you to view the information, pass it along to colleagues, understand who's sending you and when they're sending it, and giving you a cockpit that allows you to, just very quickly sort through all the information and make contextual observations about what's important to you and sort through deals that you want to participate in versus ones that you don't. But at the end of the day, we had to basically create a whole bunch of APIs, straight through processing, so it could go into any kind of OMS system or risk platform or any other security master that you might have. And we've established those, and we have firms that are taking advantage of that, looking at working with those APIs. We had to establish a fixed protocol, which we announced in the second quarter of last year, I believe, with fix.org. We work very closely with them, both on a fixed income and equity protocol for fixed orders.
Okay.
On the primary market, it didn't really exist prior to that. And then, from a compliance perspective, given some of the new regulation where the market is, it was important that we were able to give a feed of information that you can ingest into whatever compliance system you might have to handle risk, to handle any regulatory obligations that you feel you have. So overall, it's a combination of things. If you think about the way that workflow happens in many of the buy-side firms that we speak to today, where investors are basically handling information flow between the trader and the portfolio manager, again, through emails or through phone calls or different types of analog communication. We've provided a solution that allows for the trader and the PM to work on one platform that allows for the trader to electronically send and control information flow to the PM, allows for the PM to indicate their interest or the level of order that they want to place on any deal, and then allows for the trader to basically consolidate all that information, see all their information in one view, aggregate the orders that they want to place on any deal, and actually send those orders over to the sell side for completion and then for allocations back. And then it allows for the trader to basically allocate back out to the PMs in a number of different factors. They could do it manually, they could do it a pro rata. There's a bunch of algorithms that we provide for them to allow for the PMs to understand how they got filled on any particular deal.
And so that's great. We understand how that works for the buy side. Clearly, sell side syndication desks have always been a central part of this historically, as have their sales teams. How do you see the sell side fitting into this process going forward?
One, they've been integral into it from the beginning. The genesis of the idea was really from the 11 original banks that we worked with, and their simple thought was, what's the best thing that we can do to improve what we see as an inefficient way for us communicating with our clients? Mm-hmm. What's the best way that we can improve the process and think about the most value that we can provide, and understanding what value that they do provide. So we're not changing the way the market works. We're just improving the way the market works.
Bill, that's been fascinating. Thanks very much for coming on Trader TV.
Interesting dialogue, very important topics that you guys cover. So I really do appreciate the opportunity, and thank you very much.